Welcome on the show, Mr. Sengupta. It's a pleasure having you on the show. Sir, firstly, I want to talk about the budget. Obviously, it's been a non-populist budget, despite that we're seeing the elections coming in. And obviously, it seems like a budget that is bolstering the growth, especially on the Capex side. So firstly, I want to ask you your view on the Capex side. We're seeing a significant uptick also, that a rise on the Capex outlay as well coming in from the budget.
Yes, thanks for the question. So clearly it was a growth-focused budget. There's a dependence or a reliance on public investments to drive the economy. This in turn, over the medium term, can crowd in the private sector capital expenditure as well, which is our view in 2022. As the economy recovers, we think that private sector Capex is going to come back. So a couple of positives were that the Capex growth of 35% year on year in FY23 over FY22 revised estimate after accounting, of course, for the Air India equity infusion. Capex as a percentage of GDP is almost touching 3% in FY23. Compared that with 2.6% in FY22, and this was less than 2% in FY18 to FY20, which is the pre-COVID period. So clearly, there's a huge focus that the government is putting in on capital expenditure. And they're doing it at a time when they're able to achieve 50 basis points of fiscal consolidation. The tax assumptions also especially look quite realistic. So overall, I would say these are the good points coming out of the budget.
Hi, Santanu. Good afternoon. This is Anisha this side. Well, your point is taken that it's a growth-oriented budget, but what do you make of the move that we have seen in the yield market? Because as we speak, it's gone past the 6.9% level. Do you think that the street is a bit worried regarding the high borrowing figure of over 14 lakh crore and the fact that there was no mention of the global bond inclusion? Or do you think this is a knee-jerk reaction because, as you said, the tax assumptions are quite conservative or realistic per se?
Right. So on the borrowing side, clearly the huge borrowing number net of 11.6, that's surprised are already above consensus estimate. We are estimating 10.6 trillion INR of supply. This will be clearly difficult for the market to absorb, especially without support from either the central bank, that is the RBI, coming in, or FIIs. And in that regard, the bond inclusion announcement or something on those lines was important. Our view still is that India gets included in the bond index by the end of the year, which means the announcement comes more in Q4 of 2022, which means that in Q1 of 23 you actually get included, but there will be some front-loaded flows that come in by the end of the year from the bond market's point of view. So clearly, yes, the borrowing estimate is a tad above market expectations and are above consensus expectations as well.
I do wonder, it's obviously a slight bit above expectations in terms of borrowings. But, the Indian central government has also announced plans for a bit wider than expected fiscal deficit for FY22. So what could we make of that as well, and the markets as well?
So our estimation going into the budget was that the government will meet 6.8% fiscal deficit, and we were expecting a consolidation to 6.3% of GDP in FY23. It has so turned out that the government has slipped by only 10 basis points, but the 50 basis points consolidation, which we were baking in earlier, remains intact, which means that they're targeting 6.4% of GDP now in terms of the fiscal consolidation in fiscal deficit in FY23. As I said, the borrowing number, we were already estimating 10.6 trillion, which was higher than consensus expectations. It turned out to be even higher. We remain bearish now on INR long-dated securities. Three primary reasons. We are seeing obviously the demand-supply mismatch in the domestic bond market. We are also expecting the RBI to embark on the monetary policy normalization cycle in this year, 2022. And also our US economists are calling for 5 Fed rate hikes in 2022. So all that combined, we think that rates are on their way up pretty much across the curve.
No, Santanu, that point is taken that we are in for a normalization as well as rate hikes. But what is your expectation of the roadmap? Will it be front ended? Or what kind of levels are you expecting by the end of the year?
Right. So we are expecting the RBI to normalize the corridor. Remember, the RBI had cut the reverse repo by 40 basis points. So we are expecting a normalization of the reverse repo corridor in the Q1, which is the current quarter of 2022. The RBI is already on a liquidity tightening process through the VRRRs, which is the variable rate reverse repos. We expect them to continue with the variable rate reverse repos and normalize the corridor such that the repo to reverse repo spread comes down from 65 basis points currently to the normal 25 basis points. From Q2 onwards, that is the next quarter, we are expecting repo rate hikes, one in each quarter. So one in Q2, one in Q3, and one in Q4, cumulative 75 basis points, which means that the repo rate by the end of the year, in our view, will get to 4.75% from the 4% level currently.
Okay, that point is taken. But Santanu, you started by talking about the positives from this budget. Is there anything that disappointed you? Do you think enough has been done to spur the growth as far as the rural market is concerned? Because of course, the Capex allocation has gone up, but that is something that will come into effect only in long term. Is there anything that will make you raise your expectations of the GDP growth going forward?
Right. So, see, the government has clearly made a choice in terms of the path to the growth recovery. And the choice they've made is towards capital expenditure. The expectation is that it sets off a virtual cycle of rising incomes and employment. And that, in effect, will take care of the lagging consumption demand or the uneven recovery that we have been seeing, especially on the rural side. Particularly on the rural side, there was a little bit of disappointment regarding the Manrega allocations, which is the rural employment guarantee allocations being lower than FY22. But remember, when we started FY22, the allocation, what we have in FY23 is almost flat. So during the course of the year, the government allocated further. If the government thinks that the rural economy is lagging during the course of FY23, our view is that with the tax buffers that they have, they will be able to allocate more money towards the rural sector. If you look at transfer payments, something like PM Kisan transfers, they have been maintained at the FY22 levels, flattish in FY23. Allocation on health mission and education mission have also gone up a tad. MSME being a highly affected sector, the ECLGS scheme has been extended. So there are certain things that have happened. And again, as I said, the expectation is that the choice that they have made in terms of Capex leading the growth recovery, that will slowly crowd in private sector and then continue with a virtuous cycle of rising employment and incomes over time.
Okay, Mr. Sengupta, point noted. And thank you so much for joining in with us today on the show. It's a pleasure having you on the show.